Hi, I'm Scott Mentzer with Orchard Home Mortgage, and this is your weekly mortgage update. So let's just jump right into last week's mortgage rate recap. And last week was a big week, and it wasn't due to jobs data or any other items relating to the bond market, and that was due to the Silicon Valley Bank failure, which had to be saved by the FDC. This was actually good for mortgage rates because of traders seeking the safety of the bond market, which helped rates to improve. So let's take a look at the rate forecast for this week. Rates should move slightly lower. Again, the optimal word there is should, and this is being caused by the banking crisis. So far this week, we've had three banks, or up until Monday, I'm recording this on Tuesday, we've had three banks that have been taken over by the FDC, and so this is having a impact on mortgage rates more than some of the other financial data that is due out this week. Let's take a look at what's affecting rates this week. Three items: the banking crisis, the Fed, and economic data. So the unfolding reaction to this situation has markets expecting the Fed to lower rates in 2023, contrary to the previous expectations that the Fed would raise rates. This is the primary factor in mortgage rates this week. Now, that was my thoughts yesterday when I wrote this, but yesterday on Monday, there was a meeting with the Fed, the Treasury Reserve Secretary, and they came out and said that depositors for uh, Silicon Valley Bank and Signature Bank would uh, be able to have access to their full deposits. And their reason for this is that they believe there could be a lot of fallout that would affect the depositors, mainly in the tech sector. They used the banks for their payroll, and so this was a move by the Fed and the Treasury Department, federal government, to protect any further fallout and more bank failures in the future. But we will have to pay attention and keep a close eye on this to see what the long-term effects, whether the Fed will stop raising rates for the rest of the year. The second item that we have affecting rates this week is the Fed. Uh, the belief right now is that the mortgage rates are likely to move lower on the updated expectation that the Fed will have to stop raising rates to fight inflation. We'll even have to lower rates later in the year due to the concern of the banking crisis that has started. And then economic data is the third item that is affecting rates this week. Uh, Today's CPI inflation data would have been a major event for mortgage rates before the current banking situation, but now they're going to take a back seat. So the banking situation is really the main item that is affecting rates this week. I actually think now, seeing what happened yesterday on Monday and then Tuesday today, rates are probably going to fluctuate a lot this week, up and down, and most likely stabilizing by the end of the week. Uh, Rates probably are not going to go into the fives, but not go up to the sevens again either. Probably in the mid sixes. It's not the twos, but it's still better than climbing in the mid sevens. So that is what's affecting rates this week. We're going to have to keep an eye on the banking crisis, the Fed, and economic data. That is all for this week. Thanks for watching, and hopefully I'll see you next week for the mortgage update. Have a great week. Scott Mentzer, Orchard Hill Mortgage, the weekly mortgage update.